All right. Welcome everybody to the FOMC announcement hangout stream. Uh, Sorry for anybody that may have caught the earlier attempt at this. I had some technical difficulties, or if you were maybe just waiting for this to start. But either way, we finally got it going a couple minutes late. Here we are. What is it? 11:48 my time. So we're waiting about 12 minutes until we get that announcement. Let me just double check a few settings on my phone. Yeah, so just kind of been sitting here this morning, taking a look at a few companies, trying to figure out what I want to maybe value within the next week. Hola from Michael Bierne. I'm not sure how to pronounce your last name. Hey, how's it going though? Welcome to the stream. I'm not sure if I've seen you in the chat before. So, I mean, if we take a look at the markets a little bit today, they're obviously up a little bit. What's your predictions for the announcement and reaction? How about on energy? Well, I think it's pretty more likely than not going to be 50 basis points. That seems pretty likely at this point. It would be a bit of a surprise if we did go full 75. They seem to have been telegraphing quite a lot that it's going to be 50 basis points, but it's still technically possible that they go full 75. Obviously, we had a much cooler than expected CPI number last night, yesterday. So that definitely seems to indicate much more likely to be heading towards the 50 basis point option. I've actually been relatively impressed with how quick and reactive the Fed has been in getting the interest rates up. Obviously, they were slow to start. Obviously they were slow getting started raising interest rates, but by going 75 basis points each time, they've really ratcheted it up pretty quickly, in my opinion. So I think that they could actually slow down and still continue the job on inflation. I think the market is reacting too positively to the idea of 50 basis points. Like, obviously the markets have been up a lot in the last week or two, and on the idea that it's going to be a pretty 50 basis point increase. But in my opinion, I think the market is getting a bit ahead of itself. Like, that's still an interest rate increase, that's still 50 basis points of an increase. So while so you're saying so bullish, and that's the thing, is like I wouldn't necessarily call myself bullish. I think the markets might react positively, so you guess you could call that bullish, but I myself am not actually all that bullish, because I'm concerned about the economy. So you can take it as it is. Like, the market is reacting bullishly to the idea of less interest rate hikes, because in their mind that means inflation's dead, and that we've slayed the beast. But in my mind, that means we're heading into recession. So yeah, it's a little bit of a complicated mix there. Taking a look at the things you were saying, playing PBR today, down huge. Burn, nope, first time. Hoping dividend heavy stocks are a way to play upcoming 2023, 35% crash. Yeah, see, that's the thing, is like I could easily agree with that 35% potentiality there. And dividend stocks are a good way to do it, but all I would say about that is make sure that their cash flows are good. Dividend stocks aren't good just for the sake of it. They're good because they have the cash flows to back it up. So cash flow is cash flow. That's what matters. But dividend, any small dividend's good. That's what I would say, is like, don't be fooled by yield. Don't be thinking, oh, I got to go out there and get a nice fat yield. Just get a good company that has a good dividend. It doesn't matter what the yield is. It matters how well they can pay it, and how in the good times and the bad. That's what I would caution towards that. But in that case, yes, dividend stocks are good. You also asked about energy. Well, I would actually, I'm gonna outsource my opinion on that one to our Discord channel here, which I will comment on. By the way, obviously I see we got some likes there already going. Thank you for people who already liked the chat, but please give us some more likes if you're joining either later or live. Join the Discord. It's in the pinned comment in the chat, also in the description below. But here you can see our Discord. We post daily news and stuff like that. But one of the people in our Discord here, our man Zhao, had been actually talking about how the Spider Energy fund has been reaching new highs going back all the way to 2007 at pretty much a top resistance point. And I was also kind of bringing up in the comments when he was bringing that up that he didn't actually bring it up, but if you laid over oil against this, it would not look very pretty, because oil has had a bit of a tumble since then. Like, for example, we can maybe go take a look at it. Yeah, Going back. Yeah, so it's like this is sort of the same chart scenario, but you can see the oil has had this like long correction here, whereas at the XLE's like still kind of topped up over here. So there's a pretty large disconnect between the oil sector and the oil price currently. Definitely something to be very, very cautious about if you're in oil. I have no exposure to oil. I sold out of all my oil in like February, something like that. So I was a bit early on the selling out of the oil, but it was still good. But yeah, so definitely something to keep in mind if you are in oil. Pay attention to that. One other thing I kind of wanted to point out. What would we say? Energy's in a short, higher prices not driving more expiration because of government threats. Yeah, definitely. Instead of good times means bigger dividends and buybacks, significant shift not short. Yeah, energy's in a shift. That's true, but that goes back to kind of what I was just saying about the dividends, which is that the cash flows have to be good for the dividends to be good. So, it's one thing to be paying out all your profits to the shareholders, but the energy is, destroying their future ability to actually have more in the future. Like, obviously, there's a huge kind of social political wind against oil right now, which is what partially led to the low investment levels as we're talking about, which is kind of what you're saying with the government. Which is true, but I do think most of society's kind of got a little bit ahead of itself in terms of those concerns. It's like, it's one thing if we stop driving oil powered cars, but I don't think we're going to get rid of all of plastics and like ceramics and things like that anytime necessarily super quickly. There's definitely things to be thinking about. Moment of truth: more energy stocks or buy Tesla finally at $150. Yeah, we'll see about that. So I've also been taking a look literally just over the last night at this company BioMarin. I don't know too much about it, but that same buddy of ours in the Discord, I don't know why my Discord just popped over here to the other channel real quick, but he was posting some analysis which I was very interested to take a look at. These here, like he was saying, you should look at BioMarin. They have a new drug called Valtrex about to get FDA approval early next year. Apparently it's already approved in the EU, so it's pretty likely that it'll be approved in the US too. Big upside for the company, very little competitions. Listed price 2 to 4 million, roughly 1 in every 10,000 people have hemophilia A. That's the BMRM. He's estimating 20 billion market cap. He gives a pretty thorough little breakdown of a potential valuation for it. I haven't looked super closely at all the details of the valuation specifically, but I did actually really like this piece that he put down here, which put together essentially an overall pathway for the drug based off of growth of the population, the percent of the US population with insurance, percent of those people that are likely to have the target disease, people who are likely to adhere to the treatment, and then using a growth of the listing price, paying attention to the overall penetration of the drug market, and then keeping track of how many patients have actually been treated over effectively a short term, well, not really short term, but a static time period, a single period drug that's going to last about 10 years for the main growth period, and then about 10 more years for the drug to decay. But like I said, I haven't looked super closely at the actual company, but it does seem like a very interesting opportunity that I want to look at. Probably not going to be valuing it necessarily in the next week or two, if it is something that I ever decide to value. But it's something I've been looking at. Just kind of looking at their Yahoo page. 52-week high. Yeah, I mean, it's up there at a high, but I don't judge companies based off of where their 52-week high is necessarily, just like I don't judge companies off of the 52-week low. I frankly just don't look at the chart that much. I pay attention to companies based off of the operations of their business, but that is something to be paid attention to. They definitely are at their 52-week high. You look at them over the last 5 years, they're relatively near peaks. Coming out to the max, see that the peak was back in 2015, so they're not really quite near peak levels, and that has to do with a lot of the uncertainty with this approval. And I think the part of the reason that they've spiked up so much in the last 52 weeks is partially because, again, there is this drug approval on the horizon. So the fact that it was approved in the EU is probably part of the reason it's done this. But like I said, I haven't looked super closely at those details, so I can't necessarily say super for certain. But it does have a decent amount of shorting, which you might look at that as the market cap about to go down, but I look at that as actually having a floor of buyers, personally speaking. Taking a look at it has more cash than debt. As you can see here, it has $1.27 billion worth of cash versus debt, which isn't a huge amount of cash, but still. Guys, don't let me monopolize the Q&As. You know, hey, on one hand, I appreciate you thinking of other people and not trying to monopolize. But if nobody else is gonna put a question in, and then somebody has to, right? So you can monopolize away if you have no competition. It's a free market in my comment section. Anyway, so let's take a look at their financials a little bit. See, they're doing about $640 million worth of research and development versus $84 million in net income, which is pretty good to think about, because that if I do R&D capitalization like I do with my usual valuations, there's a good chance that maybe about 20-25% of the current worth of R&D is the amount that would be effectively profit savings. So there might be a higher profitability here if I capitalize their R&D for it. Yeah, 2 minutes. You know, I was kind of thinking the same thing. I've watched a few other people do streams on the FOMC announcements, and obviously, like, the news channels will all have them all going. But I was just kind of sitting here thinking, I was like, you know, you're out of school. I'm a full-time student, so I just finished up my semester, and I was just like, you know what, you could do an early stream. Why don't you go ahead and go live for that? Here, let me pull up in the Federal Reserve page just in case I want to get this ready. Yeah, so I'm definitely going to be taking a look at this company. I don't know if I'm ever going to look at it like a full evaluation, like I said, but you can see that there's growth kind of already built in. As I was kind of talking about, $2 billion is expected for 2022, but they're already expecting about 20% increase in 2023. It would be funny to see a live stream of opposite views on Jim Cramer reactions. Yeah. Oh. No, this is projections. Raise it to 4.25 to 4.5. Yep, 50 basis points. 50 basis points. Let's go take a look at the markets now. Dude. And they sold. The market sold. Look at that sell. On 50 basis points too. We're up at 50 basis points. Recent indicators point to modest growth in spending. Production job gains have been robust in recent months. The unemployment rate has remained low. Inflation remains elevated, reacting to supply and demand imbalances. Russia's war against Ukraine causing tremendous human and economic hardship, or blah, 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 blah. Seeks to achieve maximum employment 2% range, raising it to 4.25 and 4.5. Anticipates the ongoing increases in the target range will be appropriate in order to maintain a stance of monetary policy that is sufficient restrictive to retain inflation at 2% over time. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policies, the lags of which monetary policy is effective, blah, 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 blah. Yeah, nothing really new there under the sun, all the same stuff. What a sell. Energy blowing up. Is that what you're saying? Yeah. Market started to sell on hood. Bad news through 2023. Duck and cover. Yeah, we'll see. We'll see. Let's come over to my watch list here. Yeah, so we started the day with my portfolio in kind of net negative alpha. Now we're in positive alpha, so the market's diving more than my portfolio now. Small cap oils are up a bit. How's small cap doing in general? That's definitely a question. Small caps up. That's interesting. Interesting. Yeah, so I mean, we'll see what he telegraphs in the meeting, whether or not there's going to be a a lot of negative speech in his speech or not. But anyway, let me pull back over the DVN struggling. VIX is still down. Rates are slightly up, not really. Dollar is slightly down. That's interesting. The dollar is going down with it. Commodities are up. I think all the heavy volume days will be negative until the end of year bounce. I'm certain a 20-30% drop coming. Well, certain's a strong word there, but I mean, like I said, I definitely think the markets are getting ready for another downturn. There's, in my opinion, pretty hard to deny it. You can kind of look at I'm not a chart person, but you can kind of see the move here. Obviously, like I said, there is the upward movement has been based off of the idea that we were going to get the 50 basis point increase, which we got, and so that would kind of tend towards the idea that maybe we would trend upward. But at the same time, it's still an interest rate increase, you know? Like, that's the thing I keep trying to point people out to here. And then if we come over to the 10-year yield, this is the 10-year yield index. You can see that the market has basically been denying the Fed ever since mid-October, and we're already back down to 3.5% when the 10-year was up to 4.25. So you can see that the 10-year is way below the Fed funds rate now. Like, the Fed funds rate was just raised up to here, you know. So that's a huge inversion. That's a huge inversion. That Buffett chart of GDP versus SPY 1.4, 1.6 overvalued still, yep. Yeah. I'm a bigger fan of a slightly different version of the same concept, which is the MS index, the Misesian Stationary Index, which is pretty close to the same concept as the Buffett ratio or the Q ratio. It's basically the same thing, but it's just like a more mathematical way of kind of doing it, effectively speaking. But I'm a big fan of this index, which shows us at 1.98. The idea is to pay attention to the quartiles. So really, like the upper quartile would be like 1.6 for this particular index. It's not exactly like a market book to ratio, so don't think of it like the same. But we're significantly above the long-term average of stationary. Yeah, basically it's total corporate net worth versus total US corporate net worth. So you can see that that's effectively book value and corporate equity. So it is basically, this right here is the basic Buffett index, roughly speaking. But what it does is it takes the value for each of these on each of these dates and then divides it by the geometric average of the number over each given period, so that it reassesses the baseline of the number given the history it already has. It's something represented in this book right here, The Dow Capital by Mark Spitznagel, which I would highly recommend for the record. That's actually like a really good book. This is a really good book. Book value for the USA, cool, good way to explain it. Yeah. It's, like I said, it's a little bit more complicated than the Buffett number, but it's very similar to the Buffett number. It's a similar concept, but it's a little bit more of a precise estimation of it. But yeah, definitely a highly recommended book. Let's take a look. Petrobras is down over 10%. Wow. So one other thing I've also been kind of working on a lot in the last week or two since I finished up my semester is I've been working on my new DCF template, which I've been kind of promising all year. And I promised, it's like I have been working on it. I know it's I promised that I would kind of get this out much sooner. But it's a super complicated new template that I'm trying to put together to improve on my previous ones, both in kind of like aesthetic appearance, but also in total functionality of it. As you can see here, this is kind of the basic layout of it. It does have a separate page well put together for income statements, as you can see here, with a variety of graphs for all the various metrics automatically in place. It does the same thing with the cash flow statement, also with graphs for those things over there. And then also a separate page for balance sheets. And then it also takes the separate quarterly information, because you see here, this is 10 years worth of annualized information, but we also have 5 years worth of quarterly information put in place as well. And then we also do have the graphs of the quarterly information. And then the quarterly information is also turned into trailing 12-month information, so that we can keep track of all of that on separate graphs as well. And so that took a long time to basically put all these together, to have them all well knitted together, all on one spreadsheet. That part I actually had finished in like the first half of the year. And this is just the analysis portion of the spreadsheet. Then it gets into the actual projections portion of the spreadsheet, which is something that I've been working on a lot more in the background, because my current template for spreadsheets has a probability distribution that I use to assign to different outcomes for my models. But something I've wanted to improve upon in my future templates is to have a different set of probability for each separate line item within the valuation itself. So you can have different probabilities for the revenues, but also a different set of probabilities for the margins and stuff like that, and maybe a different set of probabilities for the discount rate, so that you can actually have varying sets of outcomes and then have them all multiplied together in different sets of outcomes, and then put the distribution of all those outcomes together into one piece. So like, for example, right here, this is the page for the revenues, where I can have 10 years worth of revenues put in place up here, and then assign different probabilities here. And then it shows me the cases down here, the best case, the base case, and the bear case, with the different probabilities, and then an expected value based off on those probabilities. Then from this page, I can take those outcomes and then apply a different set of outcomes for the 10 years with the margins up here, and then assign different probabilities to those margins. And then I can basically multiply both the revenue and the margins pages together to get a distribution of outcomes for the operating incomes. I can do the same thing with the reinvestment, and then slowly over time it builds up a larger distribution of many outcomes for the free cash flow. So like, this is like a distribution of 500 different valuations across the varying sets of outcomes, all giving me different sets of free cash flows based off of the different probabilities of the capital efficiencies, the margin outcomes, and the revenue outcomes. So this is something, a tool I've been working on in the background. It's going to massively improve the ability to analyze companies in a much more comprehensive way, giving, like I said, a much larger and more comprehensive distribution of outcomes, rather than just like I said, 5 specific models, which is what I was using before, which are just specific outcomes that are either going to happen or not, and then I'm assigning a random probability to them. Whereas in this case, I would be setting up a variety of specific details, and then having all those things jumbled together into a variety of outcomes, of which we look at the total distribution of them. Me likey. Yeah, it's coming together pretty nicely. I was hoping to have it finished by the end of the year. I think it's not quite going to be done by the end of the year, but I am finally, like, I don't know, like more than 75% done, I think. So really at this point, I just need to finish like the page where I do the discount rate, which is over here. And then once the discount rate's done, I just need to do a terminal value thing, and then, fix up the details aesthetically and put it all together nicely. Like some of these pages look really well, but then you come over to some of these pages and they're not really well formatted yet. So I'm still working through all the details on that. And then there's other pages where I like over here is where I actually copy paste all of the raw information in from Ticker Terminal, because that's where I get my information from. So you can see here's all the annual and quarterly statements that are just copy pasted in over here. But then I also copy paste the stock price information in from Yahoo, so that I can calculate all the various ratios. I have PE ratios, price to book ratios, price to sale ratios, or well, EV to sales ratios and stuff like that. And then I'm also calculating the beta within the spreadsheet as well, directly. So it's a new template that's designed to do a lot of things, which is part of the reason it's taken so long to put together. But it is coming along pretty nicely, I would say. So it's 12:13. We're getting pretty close to that time. Not quite press conference time yet, but we're getting there. Let's see, did they have a larger statement with the projections come out? You're gonna try it. Peace out. Keep up the great work. All right, cool. Catch you later, man. I appreciate all of your participation. All right, so let's take a look at this dot plot that they got over here. Close out some of these. Take a look at their summary of economic projections. So it looks like for 2023, they still are projecting relatively positive range for real GDP, but they have a decent amount of downside in the lower end of the range. Like the average of the median is towards the upper end of it, but there's some people within their group that seem to be projecting lower levels of economic growth. Taking a look at 2023 for unemployment, they seem to have a range going from around 3.5% to around 5% or so. I'm looking at just kind of roughly on the chart. Obviously, if you look more closely, you can get the precise numbers, but it's easier to read the charts in some ways. Inflation, PCE inflation, they see coming down to around 3%. It looks like is kind of the midpoint for 2023, though they see it possibly staying up around 4%. Come here, Mikey. Come here, baby. Come on. Okay. Never mind. Oh, I was meant to be looking at the core PC. That's my bad. Core PC they see as more like 3.5%. There you go. That's more like I was looking at the wrong one for that, but let's see here. Yeah, so you can look at this is the distribution of outcomes for real GDP. So this is a distribution for 2023, meaning so this is like the total range. The weighting of it is towards the middle. You can see that there's kind of like two peaks within the distribution, so it's not really a normal distribution. It sounds like there was kind of like two sets of opinions within the group. There's the opinion, the set of opinions that were finding it to be about 0.5%, and then there was the set of opinions that were finding it to be about 1%, and then there was the small deviations from that. Which you can see that the general deviations seem to be stronger towards the negative side, which is why we were seeing that kind of lower bar for the potentialities for it. So it kind of gives you an idea of like how the different participants within the group were seeing the outcomes. And then as it moves towards the future, you can see it kind of becomes a little bit more of an agreement. You can see like these two peaks are still sort of two peaks here, and they sort of become more in agreement about where GDP is going to go towards 2025 and into the long run. Which is not really that much of a surprise, because honestly, they basically always have the exact same story about the long run. It's always, oh, this is what we see for the long run. You know, it's kind of just the same message over and over and over again. Take a look at the distribution for unemployment, kind of the same kind of concept. You can see where we currently are. There's also a little bit of disagreement in 2023, less disagreement in 2023, but where you definitely see some disagreement is perhaps 2024. Not quite as much, because obviously this peak is not really as substantial as the other one. Come on, baby. Come on, Mikey. Come on. There you go. But then you can also see that it also moves towards a little bit more towards agreement again in the long run as well. Looking at sort of the same thing for the PCE. We'll skip the regular PCE, go down to the core PCE. That's obviously the one that matters a little bit more in terms of thinking about what the Fed wants. 2022 is where they currently are. As you can see that 2023, a little bit of disagreement, 2024, a little bit of disagreement. It's not hugely disagreement, but it's a pretty wider range. Although that wider range is still pretty tight. You can see it's really between like 3 and 3.25 ish is kind of like the range there. And then they do see it moving down in towards the long run. But yeah, always interesting to kind of pay a little bit of close attention if you getting into the finer details of the PDFs that they release when they do these announcements. A lot of people obviously just kind of pay attention to whatever headline hits Yahoo News or CNBC or something like that, but actually going into the PDFs and reading some of those details and seeing like where they agree on things, where they disagree on things, can be a pretty interesting thing to do. Hey, Trong Fan, I don't know how long ago that comment was, but just so you're aware, be careful of your language in the chat. But yeah, stocks indeed are diving. Oh yeah, let's see. Gotta take pull open my other messages, see how my other account is doing. Yeah, yep. Definitely getting a dive in my own portfolios as well. Let's come back over to my watch list. See if we've had shakeups. Looks like some stuff moved a little bit. The alpha on my own portfolio is continuing to move upward. So we started the day with a net negative alpha day for me, meaning that the market was up more than my portfolio. But that's quickly reversing course. Which is not necessarily a sign of anything in particular. It could just be a matter of luck that my companies are just not being sold today. It's just one day, obviously. Doesn't really mean anything. Let's see, when I get we're about 10 minutes away from when the press conference is going to start, so let me get that page pulled open. I'll be right here when they're ready to do it. Take a look at I'm a big fan of this website, Trading Economics. Their calendar is really good. I mean, there's lots of websites that have like economic data release calendars, but I'm a big fan of this format because it like puts the previous, the actual, and the consensus, and their own projections in like a nice line. It does by day, and then it includes like many countries' data. So I often come to this website for this, but everyone's focused on the interest rates, but we also had import and export prices came in today. Import prices were down a little bit more than they were expected, and also down more than they were previously, which import prices, if you kind of think about that conceptually, that's sort of like the excess produced goods from other countries, from outside the United States. And so that's sort of like a little bit of an inside guide into the inflation of other countries. And the other thing about the import and export price indexes is that they haven't been adjusted for all of the other like special adjustments that they do for the CPI measures in either country. So there really are just a direct, how much did the prices change at the port? That's literally it. So it's a really useful information to get like a little bit of a core CPI information. It kind of comes a little bit later, so it's like I said, it's also a focus on a specific subset of goods because it's the goods the countries are specifically selling to other nations. And then the same thing goes for the export prices, but on the flip side, export prices are indicative of US inflation, but a specific set of US inflation, the goods that we're selling to other countries. So it's something you can kind of keep in core of mind. They don't have the consensus number from what the export prices were in here, but the export prices came in at 6.3%. Versus 7.4% previously. So very interesting. I was just talking about the month-over-month one for that. The month-over-month expectation was 0.4, which it came in at 0.3, which means that export prices, again, US prices, were a little bit hotter than expected, while global prices were actually a little bit cooler than expected. Both are down pretty significantly, however, on the year-over-year number. So import-export prices, that's another interesting piece of economic data that I think is pretty worthwhile to pay attention to. So don't want to let that piece of information get hidden in the the mix of obviously the markets and stuff. Nasdaq's definitely taking its dive. Few people posting stuff. Yeah, by the way, if you join the Discord, there's been a little bit of a, I don't know, I guess a trend going on in the chat in the Discord in our portfolio group where we've all been sharing portfolio pies of our portfolios. I put together a relatively easy to use spreadsheet that anybody can open, easy access. You can download it by going to the file tab and clicking download to your computer once you get there. And then it lets you hear. This portfolio is not my portfolio. Don't think it's my portfolio. It's just some random stuff I threw in here as kind of like an example, but you can change up the portfolio however you want. I don't know. It's just, I meant to at literally AAP. We could say that they have 50 shares of that, and then you could say that they paid $1,000 or per share. You know, you can do whatever you want. You can change the portfolio around, do whatever you want with it. Save it for yourself, and then if you want to click the picture, you can save, click here, come download the image to here, and then you could share that with the group in the Discord. Or, you know, you don't have to share it. You could also just use the spreadsheet if you so choose. But if you're feeling shy about sharing your portfolio with the group, that's always an option too. But the point is, that's a free tool that I put together in the last couple of days that's there in the Discord for anybody who wants to use that. Hey, whoa, I'm feeling insulted here. I don't even know what's in that portfolio. I just made up some tickers. What you talking about? Yeah, no, I remember, like I said, I just made it up, kind of just like randomly typed some tickers in, some numbers, and then like as I was doing it, like I was literally doing it randomly. And so when you're doing it randomly, you don't think about like the proportion of the stock price to each other. And so like I ended up with some really weird pie numbers, and then I tried to kind of like rearrange it a little bit to make a little bit more sense. But yeah, I was just like, whatever. I guess it doesn't really matter. I was just like, I was like, who cares? I just wanted to show, you know, what it's supposed to be, sort of. Let's move over to so. All right, so my tool that I use for deciding what to buy is still telling me that I should be buying more Smith & Wesson and Intervor. I did buy more Smith & Wesson. Yeah, I know you're messing. I'm just playing. I mean, hey, who knows? Maybe it would do better. You know, it's like that. It's the whole concept of the monkey can pick stocks better than the fund manager, or the person throwing darts can pick stocks better, right? I mean, that's basically what I did. Is I just kind of like chose some tickers randomly off the top of my head. I mean, not super randomly in a sense. I kind of tried to choose, you know, really well-known companies. I just kind of chose some big blue chip names when I threw that together. That was kind of the idea, was some recognizable companies. But and you know, I mean, there's some things I could do also to update it. Like I said, I put together pretty quickly. There's some things I could do to make it better. I could put in a slot for the name of the company. That's one thing I could do. I could put in PE ratio, dividend yield, stuff like that. There's stuff you could do to improve it. But 4 minutes. Come on, Mr. JPOW. Come on, the VIX really wants to mean revert. Stock pressured by hawkish Fed tilt. See, it's the same message that they've been giving for like 2 months though. See, that's what I mean. It's like that's why it's just so funny thinking about like how the market was going to react today, because like everyone was kind of thinking, ooh, 50 basis points, that's like super bullish, and it's like,
guys, that's still 50 basis points increase. What are you thinking? Like, it's still an interest rate increase. Like, unless they came out and said, actually, we're gonna hold it, then it's still technically hawkish, you know. But you know, the market can get so silly in the month or two between meetings, and can get so wrapped up in its own thing. It's just so happy that it's not 75 basis points, but it's like, well, 50 basis points, 75 basis points. Fed funds is still going to four and a quarter, 4.5, one way or the other. It's still pretty up there. All right, so Mr. JPOW. You know, also with that little sample portfolio having 30% Apple, I mean, you could just say that it's like it's like index plus. It's the Buffett index. I mean, that's what I should have done. I should have just put like Buffett's portfolio in there or something. I don't know. Or maybe like his top 10 holdings or something like that. Those are, you know, some of the most recognizable names anyway, to be fair. One more minute. Right. Let me turn that music off. Probably not gonna want that playing when Mr. Powell's speaking. And I'm also gonna need the headphones. Otherwise I won't be able to actually hear him. Come on. Come on, where's the conference? Come on. Da-da-da. Oh, really? Come on. Come on, guys, trying to get it up. That's what she said.
Are they not putting it live on their website today? Jesus, normally they do. I'm trying to pull it up on CNBC now, I guess.
Year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
T-Row
The
getting
labor
slapped?
force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside.
If you don't mind me, just gonna go looking at
Despite elevated inflation,
other discords real quick.
expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point.
I'm kind of curious about this one. EBIX.
4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance
385, please.
that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect policy restraint that we're putting in place to
Jerome's
restore
like,
inflation
page
to
turn?
2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go.
Still some ways to go, boys.
The median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year.
Buy puts, buy puts, buy puts.
The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
That felt kind of quick.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial?
I love how he's just looking down while the guy's asking the question.
Effort and its fight against inflation, and if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet.
Not sufficiently restrictive.
That ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that were published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know.
I can't tell you confidently that we won't move up the rate again, guys.
Is our best estimate of what we think that peak rate will be.
Oh, man.
Based on what we know. Obviously, if the inflation data come in worse, that could move up. And it could move down if inflation data are softer.
Moderating.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year.
Oh. What's happening? Am I losing the internet? Come on now. Okay.
What is the ultimate? And that'll be the key thing. But I mean, for that decision. But ultimately,
Don't know what happened there.
The question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our own our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit, and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually.
And will continue to go up, actually.
As rents expire and have to be renewed, they're going to be renewed.
I like how the S&P's turning around.
Are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. At the biggest cost by far in that sector is labor. And we do see a very, very strong labor market. One where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher where we want to go. And that's really why we are writing down those high rates, and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. 0.5 percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting.
Man, they're going
what you
deep
said
for the
is
question.
broadly right, which is having moved so quickly.
What's going to be, Jay?
So much restraint that's still in the pipeline.
25 or
The
50?
appropriate thing to do now is to move to a slower pace.
25?
That will
25?
allow us to feel our way and and get to that level, we think, and
25?
the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they know this, that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Imagine Brainerd ran in right now, whispered in his ear that they changed their mind.
Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of
In
restriction that you need to get inflation down to 2%.
order order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You know, there you can look at history, right? And history would would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core
Yeah.
came stronger this year. Came in stronger this
Seemed
year.
like a weird
What
question.
you see is our
Chicken
best
and egg type
estimate
question.
today, really, as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That's all. That is the estimate, best estimate we make today, and as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Are they delusional or what, pal?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time.
We ain't even
historical
thinking about it.
experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two
Both.
things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So, if I think I got your question. So, one thing is to say is I think our policies and getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see.
Tell him, Powell.
Let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this.
Here, so I just pulled up in the
we need to keep rates higher and keep them there for longer.
services. This still includes the housing because they don't really have a chart on Fred X housing, but this is what he's talking about.
Readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do,
This isn't really moderating. That's what he's talking about.
Or not. It's not knowable.
This isn't much moderation.
Certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly.
Man, the markets have almost fully reversed course.
Increase in unemployment than would be expected, given
not fully back into the green yet, but man.
Hi, Chairman Powell.
Market just wants to buy.
You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy, so that the ultimate cost of getting it out of the economy would be very high in terms of employment, meaning very high unemployment for extended periods of time. The kind of thing that had to happen when inflation really got out of control, and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that, and markets are pretty confident, it seems to me, that we will get inflation under control.
Yeah, they sure are.
We're certainly highly committed to do that.
And I think they're going to get inflation under control too. I just think that the economy is going to suffer to do so.
Today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're
just no.
We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances.
Shut it down, pal.
Keep our inflation target at 2%. We're going to
Tell
use
him.
tools to get inflation back to 2%.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went
Yeah, so
through
coming
a
back over
difficult
here,
time, I think, much more
see here's like the total PCE index. It's definitely moderating, but this would include food and energy. Then if you focus specifically on the core, excluding food and energy, you can see it's definitely been moderating, which includes housing, and housing has been starting to moderate. And then he's talking about how if you exclude housing, you can see that actually
lost for whatever reason.
it's still going up. It's still going up.
Which is what we're doing.
Non-core, non-housing services still having significant upclimb.
We do.
So
Yes,
still room to go. But this number right here is up at like 5.5%. And where is their target heading? Towards that number.
Including racial groups and that sort of thing. We do. We keep our eye on that.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
Buy puts.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you
That would be deflationary.
Where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that it can there are lots of easy ways to get to bigger numbers than that if you go back a few.
By the way, if you're watching live or on replay and you haven't liked or subscribed to the channel, then I don't know what you're doing. Come on, like, subscribe. Thanks, guys.
Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been low.
Also join the Discord.
We don't prescribe.
Pin comment in the chat or in the description below.
I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Honestly, I think the Fed chair should just outright try to tell Congress what to do.
Sean Berger with Yahoo Finance. You say you
It's not like they're going to
expect
listen
5%
necessarily, but
next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course,